Today, we're talking about one of the biggest forces currently moving the global markets, the unwinding of yen carry trades.
But analysts say a key threat remains the so-called yen carry trade.
Yen carry trade and the unwinding of its
stocks selling off over the last couple of trading days, and one of the reasons cited is the unwind of this so-called carry trade.
You might have heard that Japanese investors are pulling billions out of global assets, including Indian stocks, and bringing the money back home. But what exactly is causing this, and what does it mean for your investments? Hey everyone, welcome back to my channel. In this video, I'll explain how the carry trade works, to why Japanese central bank is tightening policy, how it affects the Indian markets, and what can you do as investors. So do watch till the end. Let's begin by understanding the basics. The yen carry trade is a popular financial strategy used by the global investors. This involves borrowing money in Japanese yen because the interest rates in Japan have been extremely low for years, and then investing that money in markets where the returns are much higher. Here's an example. Let's say you borrow 10 billion yen at an interest rate of 0.1%. You convert that to US dollars and then invest in US government bonds that yield around 4%. Your profit is the difference between the interest rates, nearly 4%, as long as the exchange rate between dollar and yen does not move against you. For years, this strategy worked beautifully because the Japanese interest rates were near zero and the yen remained weak, making this a cheap funding currency for the global investors. Now, carry trades are not new. In fact, they've been around since the late 1990s. Japan was the pioneer because of its long-standing ultra-low interest rates. But other currencies have also been used. For example, in early 2010s, investors borrowed Swiss franc for the same reasons. In 2015, the Swiss National Bank suddenly removed its cap on franc's exchange rate against the euro. The result? The franc surged over 30% overnight. This caused huge losses for anybody who had borrowed francs and invested elsewhere. Many hedge funds and foreign exchange brokers collapsed as a result. This shows that while carry trades can be very profitable, they can also unwind real fast and cause high market volatility. When a large volume of money is borrowed in yen and invested abroad, it has significant effects on the global financial markets. It pushes up asset prices in the receiving country, strengthening those countries' currencies and weakening yen, as a result, making Japanese exports more profitable. In short, carry trades inject global liquidity and inflate asset prices across stock markets, bonds, and even real estate. It is one of the hidden engines behind many bull markets across the past few decades. India has been one of the biggest beneficiaries of this trend. Between March 2023 and August 2024, the yen denominated assets in Indian markets have risen from 6 to 21 billion US dollars. That is an increase of 3.5 times in just 18 months. In fact, about 23% of the global yen carry trade inflows came to India, and about a quarter of that money went into the Indian midcap funds. Japan is also India's fifth largest source of foreign direct investments. Since the year 2000, the Japanese investors have poured over $42 billion in India. So, what changed? After years of ultra low or even negative interest rates, the Bank of Japan is now tightening policy. In March 2024, they ended negative interest rates, going from minus 0.1% to a target range of 0 to 0.1%. That was Japan's first interest rate hike in about 17 years. In July 2024, the rates were raised again to 0.25%. And by January 2025, the Bank of Japan had hiked rates up to 0.5%. That is the highest Japan has ever seen since the 2008 financial crisis. Why the sudden shift though? Three key reasons: inflation, wage growth, and yen weakness. After decades of deflation, inflation has returned to Japan again. In May 2025, Tokyo's core inflation rose to 3.6%, well above the Bank of Japan's target of about 2%. Japanese workers have secured higher average salaries through strong union negotiations, putting further upward persistent pressure on prices. And the yen had been falling rapidly, making imports more expensive and squeezing consumers. So these rate hikes were aimed at stabilizing the currency. Now, don't get me wrong, Japan isn't in a full-blown economic crisis, but the situation is fragile. GDP shrank by 0.2% in the first quarter of 2025. Exports are declining and the country has one of the oldest populations in the world. The BOJ is trying to balance inflation control with economic growth. So when the interest rates go up, bond yields tend to rise as well. The Japanese government bond yields have surged in 2025. In May, the 40-year bond yield rose to about 3.689%, which is up nearly 0.7% since the start of the year. Here's why the yields are rising. First is the most obvious reason: interest rates are going up, which means the newer bonds pay more, which also means the older bonds are less attractive unless their prices fall, which pushes the yields up. The second reason is investors expect more rate hikes from Bank of Japan. So, they're selling bonds in anticipation of better returns ahead. This in turn increases supply and drives the yield up further. And the third reason is Bank of Japan is reducing its bond buying program. By doing this, they're removing a major source of demand from the market. As yields rise, Japanese bonds become more attractive. So the investors who were borrowing yen to invest abroad are now choosing to invest in home markets instead. So what happens when carry trade begins to unwind? Investors sell their foreign assets like Indian stocks or US tech stocks, and they convert the proceeds back to yen and repay their loans. This process strengthens yen, but it also causes outflows in global markets, which is what we are already seeing play out. In August 2024, about $437 million were pulled out in just 1 week from the Indian markets, mostly from the mid-cap funds. On that day, the Sensex dropped about 2,222 points, or about 2.74%. The Nifty also dropped about 662 points, translating to about 2.68%. Both indices saw intraday falls of more than 3%. Foreign institutional investors offloaded about 10,000 crores, roughly about 1.2 billion US dollars worth of Indian stocks in just 1 day. The rupee weakened significantly against the yen, and the US Treasury yields also rose, making borrowing costlier in the US. The most vulnerable sectors right now include the Indian mid-cap stocks, which saw heavy inflows and so are now exposed to outflows. US technology stocks, which were a major destination for carry trade, infrastructure companies, and other firms which have yen-denominated loans, because these companies are now facing rising interest costs. So then how should we as investors respond to this? Diversify your portfolio. Don't concentrate too much in one asset class or region. Hedge your currency risk. If you or the funds that you invest in have exposure to yen, consider hedging strategies that can help you manage volatility. Stay informed. Track bond yields, especially in the US and Japan. These changes can have ripple effects in the emerging markets. And be on the lookout for opportunities. Sharp corrections triggered by carry trade unwinding can present long-term buying opportunities in strong companies. The unwinding of yen carry trade is not just a Japan story, it's a global shift that is already affecting countries like India. As Japanese rates rise and money flows back home, we're already seeing increased volatility in bonds, stocks, and currencies. But by understanding the mechanisms at play, you can prepare yourself for what's next and even position yourself to take advantage of the opportunities that present themselves. If you found this video useful, do like and share the video and subscribe to my channel. Drop your questions if you have any in the comments below. I would love to hear how you're navigating these market shifts. Thanks for watching, and I'll see you in the next one.